Hi everyone, and welcome to the third and final video in our three-part series, Investment and Tax Planning Strategies. Today I'm going to talk about the wealth distribution phase. You've worked long and hard over the years, and you may have accumulated a large amount in your retirement accounts, your 401k or your IRA account. You have enough money to live and enjoy your second act in life, so you have begun thinking about ways of distributing money from your retirement accounts, either while you're alive or after you pass away. Prior to January 1st, 2020, if you inherited an IRA account from someone other than your spouse, you are allowed to take minimum distributions, or you're required to take minimum distributions over your lifetime. The principal will continue to grow tax deferred, and you would only pay taxes on the amount that you withdrew. On January 1st, 2020, the Secure Act changed all this. Now, if you inherited a retirement account, if you're someone other than your spouse, and a few other exceptions, you have to take the distributions over 10 years. Now, you can take it either all up front, equal amounts over 10 years, or you can wait and take the entire amount in the last year. But there are some problems with this. You may now inherit this account while you're in your peak earning years, causing this to really kick you up into a higher tax bracket, maybe even the highest tax bracket. Or maybe you're in a strategy where you're applying for a college loan for yourself or for your child, and this income is going to impact that. So what can you do? Well, here's one of my favorite strategies, and that's a Roth conversion. So what is a Roth conversion? A Roth conversion is when you take money out of your IRA account and you convert it into a Roth IRA account. Now, you do have to pay taxes when you do this conversion, so you want to see what kind of tax bracket you're in. But now the Roth IRA account will grow, the money from that will continue to grow tax deferred. And if you decide to use it, you could take it out and pay no taxes at that point. And at age 72, you don't have to take a required minimum distribution from a Roth IRA account. Now, when you pass away and the money is going to go to your child or to somebody other than your spouse, they have to take the money out over 10 years, but they don't have to pay taxes when they take the money out over that 10 years, and they don't have to worry about what tax bracket they're in or any other strategies that may impact the distribution from an inherited IRA. Now, what about while you're alive? Here's another strategy that you can do, and that's called a qualified charitable distribution, or a QCD. So there are a couple of requirements. The first is you have to be at least 70 and a half to do a QCD, and you have to make sure that you pay a charity. The charity is paid directly from the IRA, so you can have your custodian send a check directly to the charity, and you are capped at $100,000 that you can do for a year. So why would you want to do this? Well, now if you do a distribution from a charity, from an IRA to a charity, the whole amount will go to the charity, and therefore none of that will be taxed to you. Therefore, more will go to the charity. These are just two of the strategies you can implement during the wealth distribution phase. If you'd like to talk to us about these two strategies more, or some of the other strategies we can employ, please check out our website, hellowealthmanagement.com, and click on the link to schedule a free 20-minute call with us. I hope you've enjoyed this three-part series on investment and tax planning strategies. I'm Larry Heller, and thank you again.